right, let's take stock then of the way forward, how the global cues are stacking up as we head into next year. Rupal Bhansali, Chief Investment Officer, Global Equities at Double Duty Money Management, now joins us on the show. Rupal, it's so great to have you on the final trading day of 2024. And what a year it's been. It's blown past everyone's expectations, particularly the US market. In a span of 2 years, the S&P 500 is now up 50%. Who would have thought that? But now, given that, given where we're starting off, what do you expect in 2025, the first half and second half?
It's really hard to make predictions. I prefer to prepare rather than predict. And I think what I would do to prepare is to watch the bond markets very carefully, because if you notice, the 10-year bond rate in the US has shot up quite a bit. And in fact, while equity markets perform very well, the bond markets did very poorly. And I think it's really behooves equity investors to take their cues from the 10-year treasuries, which is about 4.6%. If you look at the leveraged loan market and you look at the consumer credit market in the US, it is already showing signs of stress. The default rates are spiking up, and this does not bode well. Whenever risk appetite reduces, equity markets do poorly. So unfortunately, I don't have a very positive view on market performance next year, whether it's the first half or the second half. I think a lot of the stresses that have been hidden from view because of the obsession with AI and other technological improvements, we are ignoring a lot of the challenging news that's coming out of markets.
Okay, well, that's well put, Rupal. In fact, we were just discussing, Reema and I, about similar fears that the Reserve Bank has expressed in its financial stability report yesterday about the Indian consumer, some of them being, or a rising number being over-leveraged. But before I come to that, let me parse the other statements that you made, that the bond yields are rising and the equity markets need to worry about that. Why does that worry you?
Well, I think the bond market vigilantes, like they did in the UK, are expressing their views in the US that they are worried about long-term inflation. I think we've been coming off a period of excessive stimulus, whether it was monetary stimulus post-GFC or COVID-related stimulus, in the more recent years. Worldwide, we've had a lot of money being given to corporates or to consumers. And that excess, has a price to pay. Inflation is not coming under control. And that's what the bond market is worried about, that with the incoming presidency, that those deficits will not be addressed. This is true in Brazil as much as it is in the US. So I don't want to single out any particular country. The French market is facing the same conundrum. And so I think it's a global phenomenon. And I think it'll manifest itself in people charging a higher risk premium in markets.
Okay. Rupal, at the moment, in spite, these risks are known. I mean, we have been looking at the bond markets day in and day out, hour in and hour out. But nevertheless, people are going on piling their savings into the Nvidias or to the Magnificent Seven or even lower down. Would you not do that as a chief investment officer? Wouldn't you still continue to believe that a large number of US stocks are still doing well, that they will probably get tax cuts and their EPSs may actually increase in 2025?
Actually, if you look at the budget deficit, I think the market is saying the scope for tax cuts is quite limited. Okay. But besides that, I think your larger question is, how would I invest in markets as a CIO? I think there are investors who play momentum and there are investors who play fundamentals. I am the latter. So I totally understand your point that, when the market is running away from you, there is a feeling of missing out, the classic FOMO. I guess I don't feel that because I've been in markets for 30 years. And I know the overhang and the after shock that these sorts of bubbles can create. Ultimately, valuations matter in pricing an asset, and valuations act as a gravitational force down. We are all trying to be astronauts, and I think we need to come down to earth and recognize that we need to walk, and we won't have artificial support allowing us to fly.
Fair point. So what would be your picks at this point in time? Which markets or which kind of stocks, sectors?
Ironically, for all my concerns about the the credit sector, credit markets that I just expressed, I actually think banks in emerging markets are a very good way to invest both for capital appreciation, because they're quite undervalued when you look at it from a price to book or a price to earnings perspective, and also from a credit quality perspective. Banks actually have become far more circumspect since the GFC, and they've actually gotten rid of a lot of risk on the balance sheet, and they're quite well capitalized. I'm not saying every bank, but I think in emerging markets, the real rate of interest is quite high. And I find blue chip banks, leading banks in the countries, have actually sold off or underperformed as people overinvest in technology. And some of the names I would mention, certainly in Latin America, which I think is one of the cheapest markets in the world, you will find banks like Banorte in Mexico or Credit Corp in Peru, and many other banks of that ilk. In fact, coming home to India, as you well know, HDFC Bank, one of the most blue chip banks in this country, has underperformed. And the reason they've underperformed is because they've taken it on their chin to engage in better risk management. They are one of the few banks that is refusing to grow their loan book in the unsecured consumer market and actually have reduced it. Now, that hurts margins in the short run because consumer credit unsecured is one of the highest margin loans you can make. But I think they are showing circumspection, especially because of this RBI report and other things perhaps they are seeing in the market. I would bet with a smart money like HDFC Bank and actually prefer to not take risk today so that you can actually take it tomorrow when you're paid to take it. So these are some of the opportunities that I find interesting in the markets. There are many others, of course, but I thought the banking sector globally, with interest rates, being high, remaining high, are actually very positive for their spreads.
So HDFC Bank is one of your top ideas for India. What else, Rupal, do you like?
Not much else. I'm an intrinsic value investor, and I think, I've been on your show for many years, and I actually have not participated in this Indian rally, which has, of course, gone on for a multi-year period. But I think as long-term investors, we sometimes know when you should lose the battle to win the war. And in order to win the war, sometimes you need to give up on short-term gains and avoid long-term pain, which is, massive corrections. I've been through many bear markets. And while, this one has eluded one for a long time, and I'm not alone in my view, so I'm hardly non-consensus here, I think there comes a time when you have to look at the data. So let me give you one point you've made is, what's different now? Because these concerns have been around for a long time. I think the difference now is you're looking at the data, you're seeing the default rate in the most vulnerable end of the market, which is the leverage loan market and the unsecured consumer credit market, deteriorate, not just in India, but even in the US. The other point I would make is look at the profit warnings that have come out. They've all come out from consumer goods companies. Fast moving consumer goods companies have profit warnings in India. They've had profit warnings in the US. They've had profit warnings globally. Now, whether it's a low-end consumer in the discount store market, which emerged initially in the US, or it is the high-end consumer in the luxury goods market, which is either unwilling or unable to spend, now it has seeped into the mid-end consumer. So worldwide, you're seeing profits, being eroded because the pricing power that we thought consumer goods companies had are actually not playing out in practice. So I think inflation, finally is hurting the pocketbook in a way that is now affecting corporate profits. I think that's why the day of reckoning is sooner rather than later.
Okay, that sounds dire, Rupal. But, we had fund managers for year-end chats, and one of them told us that that's why he will buy FMCG. He thought that there was sufficient scare around them. Like HDFC Bank, they're also one of the underperformers of 2024. So buy because the market fears. Is that not a strategy?
I'm not afraid to go against the grain of the market momentum and actually lean into fear, because that's when you get some opportunity. Unfortunately, these stocks have been so expensive. They've priced in so much growth that the valuations are still not compelling. Unlike in the case of the banking sector, not necessarily in HDFC Bank, but some of the other banks I mentioned, you can get dividend yields of between 5 to 8%. That is sufficient rate of return on the dividend alone that I don't even have to worry too much about capital appreciation on a long run basis. Not to mention these are ROEs of 15, 20% on very low leverage. So I think the FMCG sector has yet not offered compelling valuations globally, which is why I'm staying away, but I'm not averse to it. They're getting close to that level.
Okay. That's good to hear. Well, let me just be the devil's advocate. In this case, the devil is the bull. We had big fears 2 years ago and even last year that the US is going to end in a recession or going to see a recession as the Fed starts hiking rates. That didn't happen. Look at the US GDP. I mean, it's a picture of strength. So, can we be discussing similar fears at the end of the 2025 as well? Yes, there will be fears, over leverage, likelihood of inflation, but nevertheless, good corporate earnings. Is that a possibility?
So again, you're absolutely right. Many of us have been proven wrong in our assessments because some of the leading indicators, which was an inverted yield curve, which has traditionally been a very good marker of a recession, frankly, did not play out. I think a lot of this has to do with excessive fiscal stimulus. In the short run, you can prime the economy in ways and at a magnitude that is very hard to ignore in the short run. But in the long run, it catches up with you. This is happening in major markets like France. It has happened in the UK. Brazil, the real has actually collapsed because the fiscal deficit is out of control. I think the US is not far behind. So this is why I think the day of reckoning is sooner rather than later. That said, as investors, our job is to make money for our investors and to avoid areas where you're likely to lose it. And so there is opportunity in the market. It's a question of finding it. Another example is the tire industry. The automotive sector has been hit hard, again, as a consumer is avoiding durable goods as much as they're avoiding, fast-moving consumer goods. And in the durable sector, the automotive sector, the tire industry tends to be more resilient and is trading at very attractive valuations. And they are big beneficiaries of some of these trends that we're talking about, whether it's, move to EV, a move to larger vehicles, which everybody seems to enjoy, SUVs as opposed to compact cars. It's also playing on the mining tire industry because, mines tend to be very far from the ports and you need heavy truck and therefore truck tires, to ply those goods to where they're needed. So I think there are opportunities in the market. They're just not the obvious ones. And so we are fully invested in our clients' portfolios. The question is, are they the popular stocks or are they the compelling stocks? We would choose the latter, even if it means sacrificing near-term gains.
Okay. Well, I think I know the answer to what I'm going to ask you, but nevertheless, since this is the talking point here, the big winner, we don't have a magnificent 7, but we've had these wonderful e-commerce stocks, the Zomatos, the Zaggles, Nykas, Swiggies, which have done very well. And, we have some of these, Paytm, PB Fintech, which have kind of fallen and come up, basically the e-commerce stocks. Then we have the EMS stocks, the electronic manufacturing. India is new into this, global value chain theme. And some of those Dixons, Canes, all those smaller stocks have done very well as in, 200% gains.
No, because I'm very focused on making sure I trade true to my discipline. I have been to this movie before in many being made there and 10 years ago. And we've all seen how dramatically China. So it doesn't take a lot, for these fortunes to reverse course. And you want to be very careful as to what can be excruciatingly painful. And if investors don't know what the intrinsic value of a business is, they will not know what decision to make when these companies start going down.
Okay.
I think you need to getting. And I find a lot of investors are investing based on flows rather than fundamentals. I see people talk about, what the compelling opportunity is versus what the growth opportunity is. Growth stocks have a very potentially uncertain future when you go further out. And a lot of the growth rates, that you have to assume are very far out in the future. And the further out they are, the higher the risk premium you should charge rather than a lower one. And so I think this argument for growth stocks is sort of upside down. Investors are investing them because of the growth. And I would argue as a value investor, a bird in hand is worth more than 2 in the bush. And so you should not overpay for something too far out because a lot of things can change in the future. And if you put your down payment in a very large way upfront, then you are the one who's going to lose. And the other side who's already taken their payment upfront does not have much to risk.
Okay. Rupal Bhansali, it was a pleasure speaking with you, and it's always good to know that there are very cautious and careful fund managers out there. I'm sure many of your investors will, in the end, actually thank you for taking such good care of their money. Thank you very much for joining us, and have a brilliant 2025 yourself.
Okay,
and
moving on.
Happy New Year to you too.
Thank
Happy
you.
New Year. Happy New Year, and wish you a wonderful 2025. But now let's